So first of all, thank you everyone for taking some time and joining us today. Right. So today we have Chris with us. We're gonna go over the process of buying your first home or an investment property in terms of real estate and mortgage. What are the things you require? What's the process? So first of all, let me introduce Chris. He has been in the industry for more than 15 years. He is specialized in terms of first-time home buyers and investors. Like if you're looking to buy a second property, third property, he has been working in this field for more than 15 years, as I told you guys. Welcome, Chris.
Thank you, Naveen, for having me. Thank you for having me.
So Chris, today let's start with the mortgage in terms, like as a first-time home buyers, what are the benefits in terms of, what are the benefits for first-time home buyers? First of all, let's like in terms of down payment and also that at least we start from the base.
Yeah. So what we're going to do today, guys, is I'm going to give you a high level, just for the ease of time. Thanks to everyone for your patience. You're coming here on a Sunday. I know there's a little bit of difficulties in getting started up, but we're going to give you a holistic view of what you need to do to get into the market and what you need to do from start to end. Okay. Coming to these types of presentations and learning about real estate is your first step. Building your team of experts is also part of your first step to understand who is your real estate agent, which is Naveen here. Someone like myself as a mortgage broker to help you get the financing and get you started. And then also having a lawyer and somebody that you can talk to as from a legal standpoint, an accountant to ensure that your accounting is up to speed and you understand for example, your RSPs, which we'll touch on in terms of how you can use your tax benefits from that. So an accountant is also important. If you're buying a rental property or you're buying your first home, you may also want to have a contractor in place that can help you along the way as well. Okay. But the high level holistic view of what we're going to talk about today is really how you get started. Okay. And the first thing that I will tell you that I want everyone to leave with today is that the first home that you buy is not the home that you hold on to, that you live into forever. It's the home that you hold on to forever. Okay. And what I mean by that is that your first home, most people want to buy, they want to upgrade the home. They want it to be the nicest property. They spend money on renovating the property, which is not a bad thing because it appreciates the value of the home. But getting into the market is the most important piece. Okay. And once you get into the market, if you're starting with a condo, for an example, then you're going to upsize to a townhouse, a semi-detached, and then you can eventually get into the detached home. But along the way, why I say your first home is the home that you hold on to forever is because you can start to use that home as your piggy bank, is what I call it. Your piggy bank is now going to allow you to use the equity, which is the profit in your home, to go purchase another property, whether it be you upsizing to a bigger home and converting your existing property into a rental, or you do vice versa, and you can sell that property and upsize to a bigger home, and then buy a rental property after that, which we'll get into different strategies, which we custom design for each individual. Okay, so everything that we're speaking today is just general knowledge, but when we narrow it down individually, then we'll talk about what we call a real estate action plan that'll help you determine where you are today and where you'll be in the next 3, 5, and 7 years along the way. Okay. But more importantly, when you're getting started, the first step is to sit with someone like Naveen, which is your realtor, to get an idea of where are you today and where would you like to be as a first-time home buyer. Okay, the first-time home buyer, there's 3 requirements, three pieces of information that I want everyone to leave with is how do you get qualified? Okay, that's the most important thing in today's market of your borrowing capacity. Okay, which requires to figure out, well, what position are you in and what can you buy? So the first step is really filling out, once you sit down with Naveen, he's going to pass you on to someone like myself that'll outline that portfolio for you and determine where's your down payment coming from, what type of income do you have, and how is your credit. Okay, so we'll start with income because it really is the most important piece in today's environment to ensure that you have enough funds to be, in terms of income, to be able to qualify to purchase the mortgage. Okay, other topics we're going to speak about will be your amortization and the difference between the two, 25-year versus a 30-year. And the types of income in terms of, are you full-time? Are you salaried? Are you hourly? Do you own a business? And there's business programs for people that are getting to the market as well. Okay. But in terms of income, there's 3 different types of income. Okay. The ones that are salaried, okay, where you work your 9-to-5 job, you know what your monthly expenditure income looks like. And if it's a salary, you know that you're guaranteed that income, correct? So let's say it's $100,000 for the year. Now, if you're an hourly employee, there's a different way that the banks will qualify you. Meaning that if you've worked 1 year as an hourly and you worked overtime and your hourly rate is $50 an hour, and you've worked an additional 50 hours, for the month, that annual income that you get at the end of the year on your T4 slip, which is what your employer will give to you, that income now, if the current year is higher than the previous year, then we can take an average of those 2 years. So what that does is it helps you increase your borrowing power to be able to get into the market at a little bit of a higher price point. Okay? But then comes the qualification of, based on your income, how much money do you have for your down payment? Okay? As first-time home buyers, you can put down a minimum of 5% down up to the first $500,000 of the purchase price. Anything above and beyond the $500,000 is a 10% difference, a 10% down payment. So on a $600,000 property, your down payment becomes now $35,000. $700,000, it becomes $45,000, and so forth. Now, when you're putting less than 20% down, there's what we call an amortization period. The amortization period is how long it takes for you to pay off your mortgage. Okay? But when you're putting less than 20% down, it also decreases your borrowing power by about 25 to 30%. Okay? And the reason being is because you're paying off your mortgage in a shorter period of time, which means that your monthly payments are going to be higher. Whereas if you were to put your 20% down, you now can stretch out that amortization period to 30 years. Okay? So when you stretch it out to 30 years, you know that now your payment is also going to decrease by $300 to $400 a month. And then it gets you into that bigger property as well. Okay? So that's the main difference between the 25 and 30-year amortization. But then you have your down payment. Okay? Where does this come from? As a first-time home buyer, you're able to use up to $35,000 of your RSP money towards tax-free to be able to help you get into the market. Okay? Mind you, there is a 2-year grace period before you start to pay it back. So you have a total of 17 years to pay back the RSP money. The first 2 years, they give you a grace period to kind of get you back into understanding how to make payments on your mortgage and so forth. Okay? So as of year 3 is when you would start to pay it back. So anyone that's starting a job or anyone that's new in the workforce, your first year really should be working towards saving up that $35,000 because it's the one and only time that you can use it as a first-time home buyer. Okay, so that's your down payment. The down payment can also be gifted. Okay, we can get it from parents. We can get it from parents' line of credit. It could be a joint venture where we have 2 people connect together in the room. That if you make $100,000, you make $100,000, and you're buying a $700,000 property, we know that $70,000 each can come from each individual to help you get into the home. Okay, and then once you get into the property, you now can, as the property appreciates in value, meaning that the price goes up, okay, and the principal of the balance of your mortgage, you're paying down on a monthly basis. So everything in between is your equity, which is what we call profit. Okay, that profit now can be shared amongst the 2 of you when you either refinance the property, meaning that you pull the money back out, or you sell the property, and then you go your own ways. But again, it's just another helpful tip to get you guys into the market so that way you can start to venture off on your own in 2 to 3 years from there on out.
And even first home saving account, you also have advantage like to put $8,000 towards your first home saving account each year. And yeah, that's tax free. You can make the contribution towards first home saving account, right?
Yeah.
And that's tax free. So example, for the previous year, you should have opened a first home saving account and put $8,000 towards that, and that would be deducted from your income. Basically, it's contribution towards that, and you can use that $8,000 whenever you purchase a home.
Correct.
And that's also an advantage in terms, right? First is you can move you can use your RRSP towards down payment. You can use the first home saving account money towards your down payment, right? And even it was TFSA, right?
Yeah, the TFSAs as well. Yeah. So there's different buckets that you can put your funds into that'll allow you to use it for the first time home buyers plan. Okay. But not only now, so when you're buying this $700,000 property, you also now, when you're putting less than 20% down, there's insurers like the Canadian Mortgage Housing Corporation that's going to also want to ensure that you've got at least 1.5% of the purchase price for what we call as your closing costs. Okay. And that has to be shown on top of the down payment money that you have in your account. So 1.5%, what does that include? Right? It includes your legal fees. It includes your land transfer tax of the property when you purchase it. It includes the registration of the mortgage and your title insurance. Okay. So all of that. And then if there's an appraisal that's required, or if there's an application fee included, that's all really encompassed into that 1.5%. So whether you're buying a $700,000 or $800,000 property, it's standard across the board. Okay. And you can only put down less than 20% up to $1 million. Okay. $999,000. Okay. Anything over $1 million, you're going to be forced to put down 20%. Okay. And the reason why I say is because in today's market, it's a little bit challenging with the price points. So with interest rates being higher, you now have to qualify, +2. So if the interest rate is at 5.5%, you now need to qualify at 7.5%. In the event that the rates go up by that 2%, the bank knows that you're going to be able to suffice and make those payments without any issues. Okay. The disadvantage to it is that it doesn't get us into the market, into the price points that we want. In 2005, I closed on a property and the interest rates were very close to what they are today. It was at 5.25%, whereas today it's at 5.5%. Okay. So if you think of it from 2005 to 2024, you can see how the rates will fluctuate and go up and down. Okay. So there are two different types of interest rates, right? As we all know, there's a variable rate and there's a fixed rate. Okay, the variable rate is factored in and calculated by the Bank of Canada's bond yield. Okay, the Bank of Canada will make these announcements 8 times throughout the year. Now, in those 8 times, we are hoping that the rates will start to come down by 25 basis points every time. Okay, now, what people aren't privy to or don't follow a lot of the times is what the fixed rates are doing. Okay, the fixed rates are based on the bond yield. Okay, so the Bank of Canada is based on their bond yield for the variable rates. Okay, but in terms of the fixed rates, if our bond yield is going up and down, the fixed rates are also going to go up and down. But in today's environment, the variable rate is much higher than the fixed rate. So what people are doing is we're saying, okay, lock into a fixed rate so that way it increases your borrowing power. And then later on down the road, as the variable rates drop, then when your mortgage comes up for renewal, we can always move it over into a variable rate at that point. Okay? The reason why I share that is because previously we would educate clients to take onto the variable rate first and then lock it in along the way because you have the opportunity to do that. Whereas if you're taking a variable rate, a fixed rate first, in order to go to a variable within your term, you would have to break the mortgage, pay a penalty, and then you can transfer it over, right? Which is why variable was always the way to go. In theory, the variable rate does always win. But as you know, with these times, 2007, 8, 9, 2014, 15, now 2022, 23, the rates have gone up, right? During those time frames. But in those times, within 12 to 24 months previously, the rates did start to come down. So as they come down, your payments will also come down and your purchasing power will increase. Okay? So if you're in the position where you can get into the market today, what I want everyone to take is that you're buying a property, for the $1 million home that was on, for example, last month, $1 million property is now, really $800,000, right? It's about $200,000 less, okay? But what happens is that's because the interest rates are high. But as the interest rates come down, that value will jump back up to the $1 million, okay? So if you're able to weather the storm for those 2 to 3 years, then you'll see the benefit after in that second and third year, okay? A lot of people say that, the interest rates are too high. We're not going to buy until the rates come down, okay? And that for a lot of people is the logic around a lot of the things that we just think through our own process. But what really happens is when you're buying at a higher interest rate, you're betting on interest rates coming down, knowing that your property value will increase, which will at that point, help you continue to stay in the market. Whereas if you're buying when the interest rates are low, you're buying at the peak and there's no real equity in the property at that point. Okay?
You're giving all the money upfront. So example, if the interest rate, if you're waiting that the interest rate gonna go down and then we gonna buy, so already there would gonna be a price increase by that point of time, right? So right now, if a property is 800,000, you might buy that property for 900,000 or 870, and that won't be the difference in interest. Like even if you buy, if you get 1% higher the interest right now, still there's gonna be a lot of difference in terms, right? Still there's gonna be a lot of difference in terms of the total payment if we look for 3 years, and if we buy a property 100,000 expensive, still it's gonna make sense to buy it today.
Correct. Yeah.
Right. And don't wait for the point when the interest rate gonna go down, because in the market it's gonna be a little bit, we're gonna see a shift, right? And that with that shift, there will be like a lot of buyers coming in as well. And again, the multiple offer situation and everything that comes in.
Yeah. Well, keep in mind, right? Like we've got a shortage of homes. Builders have slowed down on building new homes because interest rates are high, right? The lower the interest rates, the more builders will continue to build. There'll be more inventory. But right now, we can't keep up with the demand because there's not enough homes, and we have, 500,000 to 1 million new immigrants coming into our country every year. So where are they going? Where are they going to live? How are they going to afford to live if we don't have enough homes? Okay, so in hopes that rates do start to come down, at that point, you'll see a lot more activity happening, which is why there's different types of properties that you can buy, right? So if you're buying a property as a first-time home buyer, you can buy what's called an owner-occupied rental property, okay, where you purchase the property, but if there's a basement suite, for example, we can use, as long as it's legal and conforming, meaning that it has a separate entrance, it has a full kitchen, full washroom and living area, then you're able to use that as rental income to help you qualify to purchase that property. Okay, so these are different strategies that Naveen will sit down and I will sit down with you on what works best for you based on your income, your down payment, and then also your credit. For most times people, coming in new to the country or just don't like to have credit because we don't like to pay interest, is to ensure that you've got 2 pieces of credit, whether it be 2 credit cards or 2 lines of credits or a combination of the 2. Okay? And as long as you have it for 2 years, the bank knows now that you can make your payments on time and you're responsible enough to make payments on 2 different credit cards as opposed to just managing one, right? So once they know that you have that tenure to support it, you're asking the bank to loan you $500,000, $600,000, $700,000. They want to be able to make sure that you can afford and maintain a payment on a $5,000 credit card, right? So that's what helps you build your credit score. The other thing around your credit is that if your limit on your credit card is $10,000, you want to make sure that you treat it as if the limit is at $7,000. Okay. The reason being now is because Equifax, which is our credit bureau rating system, they will now take into the utilization. So if you're too close to the limit of your credit cards and your lines of credit, it actually negatively affects your score. Okay. So it's really here to help people build up their credit history and how. Okay, which is individualized for each individual depending on how long you've been in the workforce, how long have you your credit for, did you just finish school? For the ones that have just finished school, always a great opportunity to get a credit card from the very beginning just to build the tenure so that way you have the 2 years can kind of carry itself along the way while you're in school. Okay. And then you use it for books or, if you need to go for any extracurricular activities, then you can use those credit cards for those reasons.
And in terms of buying your first home or investment property, the process is you see a real estate agent. That's like, if you see me and we have an initial conversation, and then we sit with Chris, and Chris gonna guide you through about the numbers, how much like you get qualified for, what's a pre-approval. We can look for like if the number is 700,000, and after we get that number, we're gonna sit together and we're gonna look, okay, what are the market areas we can look. For example, you can get a condo in Toronto for 700,000. You can get a detached in Niagara Falls for 700,000. You get a semi-detached in Cambridge. So we're gonna look at the places and the area and the price range we are into. Yeah. And then we decide, okay, we're gonna look for Cambridge, and so then from there we're gonna see the properties, like, okay, these are the properties in our budget and in our price range and everything. And then we do the showings of the property. We go and see those properties, and after that, if we like one of the property, we put an offer on it. So what are the components of offer? Basically, it's gonna be the purchase price, the closing date, which is generally in 60 to 90 days we consider. That's a closing date. Conditions onto the property. So the condition, there are two major conditions. That's like the general condition. One is of financing and the other is of inspection. So financing is important because in terms we have to see, like we generally take 5 business days for both these conditions to fulfill, or so we have to see in terms of financing, like if the property value is as per the comparables, and if like our credit, it's a final, we get the final approval from the bank, and the appraisal come through sometimes as well, right, in the first initial 5 days, so that we know our financing is secured, right, and then we take that condition out. Okay. The second is inspection. So we hire a home inspector that costs around like $400 to $500. That's a general amount. And he inspect the property, like in terms if there are any cracks in the foundation, if there are anything like the roof needs to be changed, what's the lifespan of the, what we say, like the appliances. He checks each and everything, what he can visibly do. And then from there, we know, we get the report out there. Okay, these are the changes that we might need to look into. And then we can also negotiate towards that. Like if we can ask the seller to either fix those changes, or we can reduce the price and get it done also. So after that thing, if both the conditions are fulfilled, that's for the benefit of buyer. So if any of these conditions are not fulfilled, we don't feel comfortable with it, we can walk away from the deal and get our deposit back. So the normal, and even so the day, just to go back a little bit, the day our offer gets accepted, after all the negotiation, we have to do a deposit. That generally 5% we normally see into, like it's normally 5%. It can be of any amount. So we give that initial deposit to the seller's brokerage. In Canada, the deposit generally doesn't go to the sellers directly. It goes and sit into the seller's brokerage, so that in case if the deal falls through or anything happen, we can get the deposit back. Right. And in terms of after the offer get accepted and we get the inspection and financing condition done, so we firm up the deal. That means there is no way out now, and we have to close the deal. Right. So after that, once the mortgage is good, we get the approval, final approval, everything. We discuss with the bank, everything is done. There comes the closing day, in which you're gonna sit with the lawyer. We have to hire a lawyer in between, and you're gonna sit in the lawyer. He's gonna go with the whole thing, the title, insurance, the what are the papers and documents of the property. He's gonna look into the whole agreement of purchase and sale and explain you each and everything about the whole process. And then you sign the paperwork, and then the deal get closed, and you get the keys on the closing day.
Yeah,
that's the whole, basically the general process that we generally see into for a resale property.
Yeah. So typically what will happen is, prior to you putting the offer on the property, most times when people come to us, we're going to tell you exactly what you can qualify for, and we're going to help you narrow down not just the price point, but the type of property that you can buy, and then the city that you can buy in as well. That gives you the best bang for your buck based on the property that you're looking to purchase. Okay. So if it's $700,000 is your max, as the example that we're using, $700,000 in Kitchener versus $700,000 in Mississauga is completely two different types of properties that you're going to be exposed to. Okay, so it's really a matter of, okay, do you want to commute from Kitchener and drive into Toronto if that's where you work? Or are you looking to just maybe move into a smaller home at the 700,000 in Mississauga and be able to be closer to family, friends, and your work as well? Okay, with what Naveen was mentioning to you about your deposit on the offer when it comes time. So when I narrow down your portfolio, I'm 99% sure as to what it is that you can do. The only 0.1% is because I'm not pulling credit at this point. Okay, from my perspective, I want the client to be able to tell me that, yes, you know, I have 2 pieces of credit, I have a car payment, I have a student loan, here's what the monthly expenses look like, and then I'll factor that in when I underwrite your file, okay, when I prepare it together. But once we know what it is that you are in the position to buy, Naveen will be a lot more confident in him putting in his offer, because he knows that we've already done the due diligence. So I already know what institution we're going to go to. I already know who's going to get you approved. And then that way it makes it confident from the buyer's end and for the real estate agent to go in with a stronger offer. Okay. The deposit, as Naveen mentioned, that you're going to give to the seller on the offer presentation, that deposit is also used towards your down payment. Okay, so it's one of the same. People think that it's separate. Okay, so if you're putting a 5% down, which let's say is $50,000, that $50,000 is going towards your down payment of, let's say, the $75,000. So on your closing date, you would be topping up the $25,000 that you would have to give to the lawyer, and then your closing costs are on top of that of the 1.5%. Okay, and then we'll narrow it down for you of what your down payment and closing costs look like, and then where this money is coming from. So if you have it in an RSP account, a TFSA account, and let's say your savings account, you need to provide a 90-day history of all of that money is sitting in your account to say, yes, we have this money for the last 90 days, which makes you eligible to use that money. Okay? If the money that comes in within the 90 days, if it's a large lump sum deposit, the banks are going to want to know where the money came from. Okay? Which is why I'm saying we'll work out different scenarios with 5% down, 10% down, 15% down, also with the 20% to help you get a better appetite to say what do you feel most comfortable doing. Okay, because the more money you put down, yes, it slightly increases your borrowing power. But the more important part is the higher the income that you earn, the higher you can purchase, the lower the down payment you can come up with, and you can still purchase a higher purchase price, okay, on the property. But having a joint venture is one of the, like I was mentioning earlier, that's usually what people will do, either having parents come on as a co-signer or a guarantor. Okay? Everybody understands the difference between the two? No? Okay. So a co-signer is somebody that's going to come on the title on the offer with when Naveen puts in the offer. He's going to say, okay, my mom's going to come on as a co-signer, meaning we're going to use her credit, we're going to use her income, we're going to use her any debts that she has. We're going to factor that all in to make sure that she's a good candidate to help me purchase this property. Okay? But when you're a co-signer, the mother comes on title. So she has to be on the agreement of purchase and sale when Naveen puts in the offer, because the financing is also going to be reflective of the mom being on title as well. Okay, that's a co-signer. As a guarantor, we use the exact same information, same income, the same credit, okay, and the same debts that mom has. The only difference is that a guarantor is that they're not on title. Okay, so that way you as the buyer has 100% of the ownership of the property under your name. Okay, so that's the difference between a co-signer and a guarantor. Some lenders are okay with the guarantor as long as parents have, good income, good credit, they don't have a lot of debt. Then it's easier to be more of a guarantor. But if it's if the covenant, like if the overall covenant of the file is not strong, then they're going to want it to be as a co-signer to come on board. Okay, but that also helps you increase your buying power, is why I'm mentioning the two.
If the buyer defaults, what happens?
So if the buyer defaults and mom is a co-signer, then because mom's co-signing saying that, yes, my son or daughter is going to make, and we're going to ensure that they make these payments. And if they don't make these payments, then we're going to be there to support to make the payments on their behalf. Okay. Whereas a guarantor, they also are in that same position to do that, but they're not on title of the property. So they don't have the same responsibility as.
So the EMI is taken from the homeowner, right? Not from the guarantor.
Correct. Yeah. You can use your mom's credit as a guarantor. And if you don't make your payments, it's all, she's good. She doesn't have to pay anything, right?
Well, she's still guaranteeing you that they're going to make the payments, right? So that's the whole purpose of their coming to the guarantor. The only difference, like I said, is that they're not on title of the property, but they're still responsible to help you make your payments on the property.
So instead of a co-signer, I guess they are a bond owner of the property.
Correct. If they're a co-signer, they're a part owner of the property, and it's to their advantage to be a co-signer because if something goes wrong, at least they have a say, right? And they can make changes along the way. If they're a guarantor, then they don't really have the say. They're just there to now have to make these payments. If you miss the payment.
So if you're a guarantor, will the mortgage amount show on your
Yeah, depending on the lender, yeah. But for the most part, yes, as a guarantor, it'll still show that you guaranteed, but it's not like you don't have the credit requirements of that loan amount. Okay, it just tells the loan amount on your credit bureau of how much you've guaranteed that property.
But for example, in a situation, I'm a guarantor to one of my, let's say, sons, and I myself go ahead and buy my third property where I don't want to be included, where I don't want anyone to be included, it's just my own personal property. It's a third, but I'm also guaranteed on another one. What will happen in that story?
Yeah, because we're not really factoring the guaranteed ones because you're not on title on that property, but we know that you still have guaranteed on that property for your son. Okay. Yeah.
And is it going to affect the credit scores as well for the co-signer?
Yeah, co-signers, of course, yes. It's to co-sign or guarantee. It's the same information. We still have to pull credit. We're still using income because that's what we're using to help you qualify to get into the property, and the credit. Okay, in terms of credit, being able to make sure that you're paying their bills on time, they're not over leveraged, things like that.
And then the reporting part, it's going to come on the credit score as well, the credit report.
Correct.
I think the major difference is in terms like when you're co-signing, it's on the title. You are as a part owner. When you're guarantee, you're not when you're guarantor, you don't come onto the title, but still you're responsible of making payment. Yeah, that's a major difference in terms.
Yeah. The major difference is the fact of being on title or not on title. Yeah.
It can be anyone, or in this have to be like a relationship and a creator mom.
So it can, but it's stronger if you have somebody that you're related to, right? Because it makes more sense, yeah. But if it's somebody that you're, you may not have. Some people don't have family in Canada, right? So they have to ask a friend or a coworker or a schoolmate to help them come in on board and get them in.
So how to decide the percentage? Like, is it going to be 50-50 or 70-30 when you sell it out?
Okay, good question. So when you're buying as a cosigner or guarantor, as a joint venture, you can register the title of that property at, let's say, for example, if it's you that's buying it and I'm co-signing for you, then you can register that mortgage, the property at 99% ownership for you, and then 1% for me. There still has to be a percentage of ownership. But that also depends on who your partner is and what the agreement is that you have between the two of you.
And in terms of what's the difference in terms of pre-construction and resale in terms of financing we are looking at. So let me just clear the base. The pre-construction is something that you're booking in advance. So there is no physical space or means building right now or condo right now. It's going to come in coming 3 to 4 or 5 years. So that's a pre-construction. And resale is if you're buying something like quick right now, like if you want the possession in couple of months or in couple of days as well. So that's something resale. In pre-construction, they still have to build it. So the financing, the basic financing is the mortgage gonna start when you take possession in terms of a resale, even for that as well. But pre-construction is normally for a townhouse detached, it's normally 1 year to 2 years, and for a condo, it could go from 3 years to 5 years as well. Correct. So in terms of financing, can you explain if we are buying a pre-construction or we are buying a resale, what's a major difference in terms?
Yeah, so like the main difference between pre-con and resale you're buying today, right? Like you know exactly, you're touching, feeling it, seeing it, you know what it looks like. But at the same time, you also have to qualify today, meaning that you need the income to qualify, the down payment, and you need the credit requirements. So a lot of times people will buy pre-construction because it's pushed 4 to 5 years out in terms of your closing date. So it gives you enough time to build up that income, the credit, and also come up with more money. It's usually for the down payment component. Most people will have the jobs, they'll have the credit, but the down payment is what they lack. So they need to kind of save up that $25,000 every year along the way to make it the 100K, for example. But when you're buying pre-construction, you're also buying in today's market, and in hopes that in those 4 years, that property is also going to appreciate based on the city that you're buying in by, let's say, for example, Toronto, we use 5%. Okay, so if you're buying at $500,000 and you know every year it's going to go up by 5%, you know that at the end of those 4 or 5 years, you've got equity in that property, right? Whereas when you're buying resale, your mortgage is being paid down right now. Your property value is increasing in real time. Pre-construction, in my opinion, you're also buying based on speculation, because there's people that bought 4 years ago for the $500,000-$600,000. They're coming to close today. The values are only coming in of what they bought it for, because the market has gone like this, right? So that's the other, thought to think about in terms of what works best for you. But on the resale side, you know that you can get rental income right off the hop, right? Whereas a pre-construction property, you don't need to get financing right away. So that's the main difference between the pre-con and resale for most buyers, because you have the time. But aside from that, is you're not paying property, you don't have a mortgage, you're not paying property taxes, you don't have any mortgage renewals coming up, which is what a lot of people are trying to avoid for the next 3 to 4 years, right? And then in hopes that the interest rates will come down in those 3 to 4 years as well, because there's no mortgage.
And then you...
One more. If I'm an investor, should I buy a house or a condo? Which is profitable?
I'm always going to say house, right? Because you got land value, right? With a condo, you're paying property taxes on airspace, right?
But you have to pay a lot of maintenance, right? But then it goes wrong.
Right, and you have a maintenance fee, right, which will go up every year. It's on pre-constructions, the maintenance fees costs are low because everything's brand new. On condos, everything's new.
House maintenance.
The maintenance fee on a house? Yeah. Well, I'll give you, for example, for me, I don't shovel my driveway and I don't cut my lawn, right? So those are my maintenance fees. My maintenance fees is what I'm willing to spend to get to pay for those things, or I have to do it myself to not have to spend the money.
And in terms of if you're looking for a rental property, like an investment property, so if you invest in terms of a condo, you're always paying maintenance fee. That's like $300, $400, $500, depends upon the condo to condo. Some condos go for $800 as well. And in terms of your house, if you are buying a house and you're renting it up, so all the utilities and everything, they're gonna take care of, and the maintenance is mostly the maintenance, the tenants are covering it out. But the major repairs, like if there is anything with the furnace, if there is anything that's a major repair you're looking for, depends on how you prepare your lease as well. It's always beneficial if you buy a freehold property rather than a condo. If you can, if your budget is that allows a freehold property, always go for that. But it again depends on criteria to criteria and scenario to scenario, right?
Yeah, you're gonna I would suggest on an investment side, condos are hands free, right? But if you're buying it new, your maintenance fees start low. So the older the building, the higher the more expensive the maintenance fees are going to go along the way, because now they have more to maintain, right? It gets as it gets older. Whereas with a freehold or a detached home, you now have a little bit more of a increase in appreciation on those properties, a lot more than a condo, right? Because right now there's not enough land, so we can only build up as high as we can. So any land that we do have, it's going to be a lot more expensive, and the values will continue to maintain itself and go up at a higher pace, right?
And in terms of land, we are talking about the development area, we're not talking about overall land, we're talking about the development area where we can actually construct housing and all. That's not in a green land, right? So it's always better to own something like a land. In terms like if you have a detached property, there might be a chance like you save it for a couple of years, you can put a basement, like legal basement as well. So then there comes additional income as well, right, from there. So you can separate separately rent the basement and the upper portion, and that's going to increase your basically rent as well, right? And you can get a positive cash flow. So cash flow is a basic term that means whatever the expenses of a property and the income, the difference between them. So if you are getting a rent from a property is like $4,500, but the whole expenses of the property is like $3,200, so $1,300 is the positive cash flow that's going to come into your account every month, right? And then that's how, like, it's always beneficial if you can afford, and if you have a budget in terms of getting a semi-detached or freehold property, what we're talking about, it's always beneficial to go for that.
Yeah. So like depending on the style of home, the rental income is going to determine if that's going to be a sound investment for you. Okay. But when we build out portfolios for our investors, we're showing them how to grow their portfolios. So for example, with my clients, I get them to buy a resale property first. Okay. Once you buy a resale property, you let that property appreciate for the next 2 to 3 years. Let's just say 5 in today's environment, just so it gives it enough time to go up in value. And then the principal is paid down. On your renewal date of when your mortgage is up for renewal, now what we do is we refinance the property, meaning we take the money out that you put, so you can borrow up to 80% of the new value. So remember that property in Toronto was going up by 5% every year. Okay. So if it was a 500,000 and now you're going to buy 5% every year, you can borrow up to 80% of that new value, which means that a lot of the money that you put towards your down payment as your down payment is going to come back to you. Okay. So technically you almost bought that property with 0% down now. Right. But now we take that same funds that you refinance the property, and then you can go buy a pre-construction property, for example, and let it ride itself out for the next 4 years, right? And then when that property is up for maturity, when it's ready to close, then again, you have room in your principal residence where you can still refinance your home if you wanted to in case you need extra money. But it allows you to use your money twice, one on the resale side and then one on the pre-construction side. So there's a timing to your question. There's a timing as to when you buy, in my opinion, as to when you buy resale and when you buy pre-con. And it depends on the situation that you're in as well, right? If you've got equity in your home, we educate you on how you can either use the equity in the form of a line of credit, or you use it with cash out, like whichever makes the most amount of sense. And then the negative positive cash flow, that's in today's environment, it's heavy. Like you're looking at, anywhere between $1,000 to $1,200 in negative cash flow every month, right? Because the interest rates are high. But for me personally, in the last, 15 years, my properties have now, yes, they've gone up in value. The principal is paid down, but every time I refinance them, whatever the rate is at the time is what I'm privy to, right? So now I got to factor in that interest rate and the cost of borrowing to borrow that money to say, well, the next property that I invest in, is that money going to cash flow to help me pay off the money that I borrowed from the line of credit, right? So the whole goal is to try and recycle your money and pay yourself back at the end. But it doesn't happen in a short period of time, right? It'll take your 5, 7, 10 years along the way to do so.
But basically you have to start somewhere. That's one of the major thing, right? Even if you start like the initial conversation we were having, right? Like you have to, your first home is not your final home, right? So whatever you get qualified for, at least start investing, and from there you're gonna develop and take so even if you get a condo, you're gonna get a townhouse or semi-detached later, and then from semi-detached you're gonna get a detached. But you have to start somewhere, because it's gonna appreciate, and then you take the equity out, right?
Yeah.
You go to the bank after, like the thing Chris was telling, is refinancing. Refinancing is basically, so if you bought a property for 800,000, after 4 years, 5 years, your property become 1 million. So you go to the bank, you say, okay, these are the comparables. So I feel like my property value is 1 million now, so I want you to refinance a mortgage. So they're gonna give the 80% of like that, and they're gonna give you the money back, right? They're gonna give you a HELOC, right? Home equity line of credit, or you can take the high mortgage as well, and then you can use that money to further invest, and like that's how like you get your initial investment back.
Yeah. So we design these portfolios. Okay. What Naveen's talking about is we design these portfolios and we customize it to you individually. Okay. So depending on your scenario, if you're a first-time home buyer, then the strategy along the first-time home buyer, just in a nutshell, is you buy your property, you hold on to it, and then you either keep it as your investment property and you upsize and purchase a new home, or you sell this property, upsize to the new home, put more money down so that way your mortgage payments are now lower because you're buying a bigger ticketed purchase price. But with the equity that you've put into the property, if you're putting more than 20% down, we can borrow that money back in the form of a line of credit. Okay? So that way your monthly payment on your mortgage stays low. You have access to a line of credit, which we can now use towards purchasing that next investment property. But in order for you to know what all those things look like, we design that for you. And we map that out. So now have a goal that you can work towards to say, I'm buying this property for right now for $500,000 or $600,000. We know what our exit strategy is going to look like. Getting into the market is you can take all this information and you can go buy a property tomorrow, right? Which is fine. But what do you do at the end, right? That's the more important part in my eyes as to what happens. How do you pay yourself back? How do you upsize? What's happening within your household within that 3 to 5 years? Are you engaged? Are you to be married? Are you single? Do you have kids? Are you looking to grow your family? So all of these things we take into consideration to determine what type of property you buy next.
Right. So that your finance is done by a bank, and what will be the interest?
So we have access. My broker, we have access to all of the banks. Okay. So when I design your portfolio, I also have a good idea as to what institution I'm going to based on what you can qualify for. So the question is such a great question. How do you know? Because some banks, when you get a line of credit, they'll factor in the payment on the limit of the line of credit. So if you get a $300,000 line of credit on your property, you're factoring in a $5,000 plus payment on your debt servicing ratio. So the trick behind it is, we go to an institution that doesn't factor in the limit and they factor in only the balance. So if we're using $140,000 out of that line of $300,000 line of credit, we know that, okay, we're only factoring the payment on the 140, which will allow you to go in to purchase that $700,000 property again. So those are different strategies as to what kind of works best based on what institution you're with, how much equity you have, and then the type of property that you can buy. But we future date that. So we know that if you're buying your first home, we know in 5 years, your home is going to be approximately X, your mortgage balance is going to be Y, and then we know, okay, approximately here's how much money we can pull out of that property for you to go do something else, right? And then if there's a shortfall, like if there's only $80,000 in equity that we have access to, and you want to buy another property for $600,000, then you have to make up the difference within those couple of years as you own the home.
And how often can you refinance? I mean, is it a certain time period?
You can refinance your property as many times as you like, as long as the value is there to support it.
After year.
Yeah, if the value goes up high enough, then yes, you can do it as many times as you can.
And it's not necessary to go with the statement of mortgage that you have, let's say.
No. Like I said, like every bank has their own appetite and they have their own criteria of how they qualify you to purchase the property. So the line of credit is a perfect example, because we know that if we're going to an institution that's using the limit, then obviously we're not going there, right? They may give us the better rate on the mortgage, but if it doesn't fit, it's okay if the rate's 15, 20 basis points higher on the other side. The bigger picture is that you're getting into another property, right? So it's not always just about the rate, right? Remember, rates are going to go up and down, right? But right now, because they're high, people are kind of afraid to get into the market, and they also have to make sure that they have the monthly expenditure to support it. But the bigger picture is in those 3 years when the rates come down, that negative cash flow that Naveen was talking to you about on a rental property, that's going to turn into a positive cash flow. So if it's costing you $300-500 a month for the next 2 to 3 years, that the next 5 years when the rates come down, and as they continue to come down, you're going to cash flow on those properties and make up for the negative that you paid for those 2 to 3 years, right? So it's not just getting into real estate and understanding about how many properties you can buy. It's also a mindset. It's a thought process around it, right? What's your vision, right? So like I always say with Naveen's clients when I speak to them, it's you need to have the vision, you need to have the strategy around it, and then you need to have your executors, which is, you know, your accountants, your lawyers, your home inspectors, your appraisers. Like those are all the executors that help you put the process together to complete the process in a whole, right?
And in terms of mortgage broker and going to a bank, the major difference, like what it is, like if I'm working with you or I'm going directly to a green bank, don't take the name, I'm just going to a green bank, there might be a chance the green bank would take the line of credit in terms, right? You already have a mortgage with them and they take your line of credit in count when they're doing it. So major advantage in terms of working with a mortgage broker would be so that you have access to green bank, red bank, blue bank, and you can look into that, right? And that's one of the major advantage. You can look into that according to the profile. Okay, this one seems to be fine. The interest rate is good. And this is a better qualification in terms of that, right?
Correct. Yeah.
They offer more things in terms.
Yeah, the having access to all of the banks as a mortgage broker is the major, in my opinion, is the major difference than just going directly to the bank. The second component to that is that we're strategizing all of the things that you're doing from start to end. I don't have access just to that one product. So if I'm putting you with the green bank first at the beginning and into your first home, we may be going to the red bank the second time around. You know, at some point when you're growing your portfolio and you're buying multiple properties, you're going to hit a wall in terms of getting financing, right? So now as you educate yourself through that process of your first, your second, third, there also are what we call alternative lenders, right? And those alternative lenders have a higher risk appetite where the interest rates are now 50 basis points higher. Okay, they'll also charge you a fee to facilitate the transaction. But the bigger picture, again, is not about the rate. It's not about, you know, the rate or your amortization on those. It's more of you getting into the property, right? And how do you get in? And then when you go to an alternative lender, as that mortgage pays itself down and the property appreciates, in those 2, 3, 4 years, depending on your personal scenario, you can move it from a B lender and go to an A lender again, right? But you have to understand and see the value of why it's important about, it's not just the interest rate. It's the bigger picture of the type of property you're buying and the amount of profit that you're going to earn on that property throughout that 10, 15 years.
And in terms of, Chris, the other topic we generally hear is buying a car that has $1,000 payment before buying a house. How does that impact in terms of getting a mortgage?
$1,000 is a huge impact, first of all.
Let's say $500.
But even 500 is a big number, okay? Like the lower the debt, if you have no debt, it's easier to qualify for a higher purchase price. And then you go buy your car, right? But a lot of times people will buy the car first without getting a property. And then the payment is what negatively affects your borrowing capacity, right? Because that $1,000 on a $500,000 even dollar property will bring it down to like 420, you know, 440 to 430. Like it's a huge number that it decreases your borrowing power by. So always, I know we always like the first thing we do when we finish school.
Okay, and then if you got accident.
Yeah. Sorry, if you're a co-guarantor.
See, I have a car loan, and then my co-guarantor does not have any car loan, nothing. So still the points can go up.
Yeah, but I think what Naveen's saying is like the better way to structure it is to buy your property first, then get your car. But if you're buying the car first and we have to service the debt on the car, then it decreases your borrowing power. Yeah.
It doesn't mean you have to sell your car. We have to sit and we have to sit and plan and see how the numbers work. And then No.
Yeah.
Yeah, it might not make sense because you might need that money for your down payment as well, right? Might be the ratios are still in line. So we have to sit, have a plan, and work some numbers out, and then just don't pay off your car loan. We have to sit and discuss about it as well.
Yeah, get something like within the 350 to 500 range. That's usually on average is what doesn't have a huge negative effect. Yeah. But even 500 is still a big number, like when you factor it in. Yeah. So that'll determine now. And when Naveen was saying with townhouse, like condo fees versus freehold, right? When you're buying a property with condo fees included, your price point is slightly your monthly payment, I should say, is very much similar to a property that you buy without condo fees, right? And because now you're moving the type of property that you're moving out of. So in a condo versus a townhouse, okay, condo has maintenance fees to it. The townhouse does not. But you can qualify for a higher price point on a townhouse because there is no condo fees inclusive, right? So now it's a matter of what type of property do you buy and how do we narrow it down for you as an example to say, here's why you buy the townhouse, right? Maybe later on you buy the condo because it'll be a bit better for you to afford at that time.
It's a good point. What is the difference between a maintenance fees and a portal fees? Like we see a lot of them has a 40 fees as well, right? So
yeah, it's one of the same, to be honest. It's just a different way that it's broken down in terms of how they charge you.
In terms of POTL, it's a portion of tied land, and in terms of condo, you have the maintenance fee. You have to pay it for the price for the POTL generally in GTA area is like $90, $100, $120. It's basically the land. You're paying for the if you see the townhouses, mostly townhouses as that, you're paying for the parking or you're paying for the road maintenance in that area. So that's a POTL fee. In terms of a condo maintenance or the difference in that, so you're paying for the building full maintenance. That might be the gym, other swimming pool or other amenities, right? So that's major difference. But POTL is basically for townhouses. It's basically if there's a project and the townhouse is on a tied land, they generally consider it. So all the amenities, visitor parking, road maintenance, and sometimes driveway as well, so they cover in POTL. So that's a major difference.
Yeah, and it's a lot less. It's not as high as
it's less. It's like $90-$100 on a regular basis.
Still though, often increase management fees can increase to any amount the other year.
Management fees. On the POTL.
So POTL generally doesn't increase that much, but for a maintenance. So whenever we buy a condo, there is another condition that we put in. That's a status certificate. So the status certificate is a piece of paper that shows how much money is there is as a condo for maintenance and reserve fund. So if there is any major repair in terms of a condo, like the full building, so that there should be enough reserve fund to support that. So the other condition, I was talking about the status certificate. We put a 5 days condition or 3 days condition for status certificate before confirming that we're gonna buy that unit. We check the status certificate and we get it reviewed by the lawyer, the real estate lawyer we're gonna hire, and we get it reviewed and he checks if this condo makes sense as well, if there would be any other contribution for that, because sometimes if it's an old condo or there is not enough reserve fund, they might ask you to put $500 more this month to put money towards reserve fund. They can ask you for the extra payment. So that's something we have to look into before buying a condo, right? Because you have to check the reserve fund, you have to check everything, if they have enough money to maintain what all facilities they are providing, or in future they might rise, there might be a chance, if it's a very old building, there might be a chance they might make another contribution, ask you to get more, do more contribution towards that. So you have to keep all those factors in mind. So that's why there is a condition for status certificate in terms of buying a condo.
Yeah. The status certificate is telling you how much money that condo corporation has in its reserve fund to maintain that building, right? So if it's in the negative, we check the status certificate from our end, for the bank's end, to make sure that there's no liens or encumbrances against that condo, right? They haven't been sued. If they've got any work that's been done on the condo at the condo corporation itself, we know that they've paid the contractors and there's no liens. They haven't put a lien on with the corporation, right? So it's a matter of making sure that there's a healthy reserve fund. So that way we know that in the event that they wanted to replace, the wallpaper or the carpets in the hallways, or they want to put security cameras in each of the hallways, they have enough money to do that without your maintenance fees going up in a significant amount, right? So just managing the budget and making sure that there's enough funds in the reserve fund to keep the condo going.
So that's very much it in terms of status certificate for the
status certificate, yeah.
And rest the lawyer gonna take care of everything. We give that task to the lawyer to review it in proper manner, because it's not a single document. It's a big file in terms.
It is.
And in terms of the status certificate, even as he told, the bank also look into. There are some of the condos which bank has blacklisted. Okay, we're not gonna give mortgage on these condos because they don't have enough reserve fund, or the quality or the
marketability of the property is not there. They haven't done enough work to the property to say that yes, it's worth what you'd be buying it for.
So is there a list that we as laymen can get that which are being?
No. Yeah.
So it depends, right? When you get the status, normally what we see, we go and book a showing for a condo. They generally have a status certificate already. When they put the property on sale, they generally order the status certificate, and you generally get in a day or two. Normally it takes 3 to 4 days, but generally 1 to 3 to 4 days, you get it, and you can ask your lawyer to scan it, right? Pre-check it, and then you can put an offer as well. Right, so that's one of the advantage you can do, and even you can give it to the mortgage broker, and he can also put it in the bank system and run some numbers on it.
Yeah, we can to check the to see if the property is viable or not. We can check it. We just need the address, right, and then we can do our search on our end. Yeah, but a lot of those areas, you obviously don't want those properties, but there's some people that own properties in those areas that they're trying to offload and try and sell. Right, so that becomes a challenging piece at that point. So, but really, guys, the overall concept of what we're doing today is to give you a good understanding of why it's important to get into the market in today's environment. Okay, because everyone asks me when's the best time to buy. Okay, and the best time to buy for me was yesterday. Okay, and the reason being is because you're in the market, right? People say, well, we want to wait till interest rates come down. Some people say, well, look, we want to wait till interest rates go up, because when everyone's backs up against the wall, that's when people dive in.
Right.
And that's when investors will come in and they'll start to buy multiple properties, because remember, there's people that their mortgage payments have gone up. There's 60% of the population, and this year alone is their mortgages are going to come up for renewal, which means that if they were at an interest rate of 2.69 to 2.79, or 8.9 to 5.79, you're almost doubling your monthly expenditure. So at some point, right, throughout that process, they're now going to come to someone like myself and say, okay, you know what? We're in debt now, in credit card debt by $40,000-$50,000. We need a second mortgage, which is a lower interest rate, to pay off that credit card debt. Okay, and then at some point, it's going to get to the point where they may not be able to manage that property any longer, and they're going to be forced to sell. Okay? So when people are forced to sell, investors that have the money to play with will come in and buy these properties, right? And then they'll either rent it back to the homeowner, or the homeowner will take that cash, downsize, and they'll find their own place to rent, and then we find a new tenant to take over that property, right? But
for how many times the bank, how many defaulters you have to be when bank seizes the property?
Usually so it's a good question, but I'm going to tweak it for you. What happens is the bank will, if there's let's say the property is $1 million, and let's say your balance of your mortgage is $700,000, the bank knows that there's equity in that home, right? So when they say that, yes, they're giving you those grace periods, they're also eating up a lot of the equity along the way to help you make those payments, but they also will keep a buffer in the event that you stop making, if you can't make payments and you haven't caught up. That's when they'll come in to put the locks on the door, right? And then they'll start to do their proceedings on that end.
What happens once banks are verifying the income with CRAs? Like, as you covered all out.
So so tell me, when you say what happens, meaning like what's the advantage, disadvantage, like what's the pros, cons? They're doing that to eliminate fraud.
Yeah.
Right? Because there's so much fraud going on in the market, in the industry. But even with the fraud, to be honest with you, there still isn't delinquencies on people's homes, because people will always pay for their home before they pay for anything else. But by them putting on the credit bureaus, it's just narrowing down that one aspect to say that we know where you work, we know how long you've been working there for, we know how much income you earn. So it also saves the lenders a lot of time in their back-end process, because they have somebody on the phone calling the employers to confirm and says, oh, does John work here still? And does he work? Does he earn the $100,000 that's on this job letter? Was it you that signed this letter? Or was it the HR department? And, they do their verification. So I think it'll help streamline and speed up the process from an underwriting standpoint on the back end, and help people kind of move forward within the transaction a lot faster.
My point is, like, there's always a buffer what you can pay for a mortgage and what banks give you the monthly thing. Like, for example, a bank qualified you for a 2,000 monthly mortgage you can pay. But there's always a buffer that you can pay. You might be able to pay $500 more.
Okay.
Will that thing narrow down and the house prices won't go that much up?
No, like if you have the extra $500 a month, for example, personally, the bank won't factor that in. They're only going to factor in what you're showing on your actual income. Okay. But if you have like contributory income, so let's say like your significant other or a family friend or whatnot is going to live with you, and they're not on the mortgage, but you are, it's only you. We can use what's called contributory income to say, well, look, you qualify for $700,000 on your own, but I'm going to come and live in your home. I have nothing to do with the title. I have nothing to do with the ownership, but my income that I'm earning, that I'm paying you, is contributing towards you purchasing that property, which will help you increase your borrowing power.
And in terms of criteria, the criteria gonna remain like what in the news as the criteria gonna remain the same. It's just like with the CRA connection, they just wanted to verify and reduce the fraud. So the only difference would be the verification part. I feel the criteria, it's still the same, right? Because you provide your income documents, you provide your notice of assessment, T1, generally if you're self-employed, you provide your other T4s and all. You still show the same income, right?
Yeah.
So you already are giving so there might be a chance they directly take it from CRA and you don't need to provide those documents.
Yeah, like in the future, sure, great point. Like in the future, potentially, they may just say if it's on your bureau, but they'll still verify the check, because you may have left your job from one to go to another, and you still have to. The other good point, guys, for when you are, let's say, you finish school and you in your job, and yes, you've got a good income, any job that you get into, you have to make sure that you're past your probationary period.
Yeah.
Okay, so like if you're working for the city, for example, or like any government offices, they're usually about 6 months, right, in your probationary period. But any other any other type of field that you're in, it's 3 months, right, to make sure that you've qualified.
So make sure you have a permanent job and you're not on probation, right?
Yeah.
That's before going forward towards finalizing a property or putting a mortgage.
Yeah, like the average income for today for someone purchasing a property is about $120,000, right? And then that way and then depending on down payment, plus or minus, right? Just to give everyone an idea. And then of course, if you have combined income, then it increases your borrowing capacity.
And it might not make sense for you to buy a home right now and to live, like for yourself to live in. It might make sense like, okay, you're paying a low rent, you're just paying, your rent is like from past 6 years, you've been living there, your rent is just 1,700-1,800. And you might get, there could be a chance, like at least you start investing somewhere and rent that property. You can buy an investment property. Right?
Look, I'll tell you, 6 out of 10 first-time home buyers that come my way, they're all saying, look, like we live at home. we understand the first-time home buyers plan gives you your land transfer tax credit up to $4,000. You get the $35,000 in RSPs that you can use towards the first-time home buyers plan. But they're just like, we want to buy a property and just get into the market, and we're going to pay the 20%. We're going to buy it as an investment property, and we don't care about this first-time home buyers plan. Right? They're not worried about the $2,000 or up to $4,000 that you're getting on the land transfer tax. They're more concerned about getting into the market, not having to pay that mortgage, to Naveen's point, right? And if they're living at home, great. But a lot of people who are buying and continuing to live where they're renting, the rent is cheaper than them paying the mortgage on the property, right? So if their rent is $1,200 or $1,400, and they buy a property now and they're negatively cash flowing $500, well, now your rent now becomes $1,900, right? Or $2,200, depending on what you're paying. But you're still putting that money towards your own home. So as someone else is paying down your mortgage, you're paying down mine, but you're paying it down at a lot less of a monthly payment, right? So it's feasible for you to stay here and take on the additional debt of the property that you buy. Right? And then these are also things that we factor in when we design your portfolio to tell you what works best and make sure that it fits within your budget. But a great point.
Yep. It might not make sense for you to move your place, right? Like because of the load.
Yeah. Like I said, a lot of people are buying today investment properties as first-time home buyers, and they're paying the 2, 4, 6, 7, whatever, however much out of their pocket on a monthly basis. So if they're living at home, and it's costing them $700 to pay their own towards their own property, they know that later on down the road, they'll get this money back as interest rates drop, right? And as you refinance that property, right? And then you're going to positively cash flow, right? And then there's also a tax component to it, right? So if you're negatively cash flowing, you can deduct the negative, but and you can also write off the interest rate. But if you're positively cash flowing and you make $100,000 a year, that additional cash flow is taxable. So it's added to your income. So you got to find that sweet spot to say, well, is it better for you to negatively cash flow or better for you to positively cash flow?
I think we're good. So do you guys have any other questions?
I actually do. You were discussing about 2005 home that you sell for 5% interest rate, right? What happened at that time? Why was the interest so high? How long does it take to go down to normal interest rate? And
Yeah.
What's going on? Like currently it's at 5.25. I'm not in the market, but I know a little bit about it.
But the rate?
We'll talk about Naveen issues.
Yeah, it's good.
Right?
Yeah, good. Yeah, at that time, interest rates had just gone up. So I bought those properties pre-construction. So it just happened to close in 2005. And when it closed in 2005, the rates jumped up to 5.25. Very similarly to what's happening with inflation and cost of goods going up, and people aren't able to the cost of goods being higher. The interest rates also went higher to kind of slow that down, right? But within the 3-year term, because I was on a 3-year term, the rates did come down, and I was able to weather the storm, yes. And then I did the same thing. I refinanced the property, I pulled the money out, paid myself back, right? Because I knew that I was paying, like the interest rates when I got qualified was at 3.29. So this technically went up by 2%, which I didn't budget for. So that 2% difference that I used from my personal savings, when I refinanced the property, I paid myself back that difference. And then the remainder of the funds is what I used to go buy another property with it.
And the thing is, right now the interest rate is high. We know that. And even we see positive news out there, like they're going to decrease it further going down, right? But right now the prices are also good. If you compare it to last 2 years, like the prices are also good. If you compare it to 2020, 2021, the prices are good. And once the interest rate going to take down, like the moment it's going to take down, there will be a lot of buyers coming in, and then the expectation is the price going to go up as well. So it's on you if you want, because the interest rate, once it goes down next year more, you can always refinance it and you come down to the lower interest rate as well. But in terms of property price, if you buy it good price today, and after, like if the price goes, you buy you don't have an option to go back, right? If you buy at a higher price. So that's one of the major thing we wanted to discuss in terms, right?
Yeah.
Because even if you pay higher interest rate but you bought a property 100,000 or 200,000 less, so that makes more sense.
Yeah.
If you compare the number at the end, right?
Yeah. In our industry, we say like, you're dating the interest rate, right? Because it's always going to change at some point, right? Till you get married and you lock it into a fixed rate, right? So once the variable rate is, once the fixed rate gets to a certain percentage, then, you lock it in. But the variable rate is a little too high. Even the discount on the variable rate is not as good as it was, 2 years ago. But it's slowly coming. It's slowly going towards moving in that direction. And then it's just a matter of the rate starting to come down, right?
It's date the rate, marry the house.
Yeah, it's true. It's true. Yeah. But yeah, like what we do overall is we do what's called a real estate action plan. Okay. And the action plan is really to design everything for you from start to end. Okay, so it starts off by you going to, for example, if it's coming into my wheelhouse, you go to chrisdesousamortgages.com. It takes you directly to an application page. Okay, once you fill out the application, it comes to my office. Once it comes to me, our turnaround time is within 24 to 48 hours, and then we design your portfolio and tell you all the things that you can do. Once we do that, we get on another call with you after to say, okay, let's have a call to understand where your headspace is at in terms of the down payment that you're going to come up with. Okay, because on the application, we'll already know what your income is, what your assets are, and what your liabilities are. Okay, but once we go over that whole portfolio review, then we guide you to say, okay, we're not pulling credit. Here's where your down payment's coming from. Here's where your income is. We pass you back on to Naveen, and then Naveen starts searching for properties within those price points. Okay, once you guys narrow it down, whether it be a condo, town, semi, whether it be in Kitchener, Mississauga, Waterloo, wherever it may be, before you put in the offer, Naveen's going to send me a copy of that listing. Okay, and then we're going to fine tune the numbers. We're going to make sure that everything that, we said we can do is that we're able to do. Once the offer gets accepted, it comes back to me. We already know that you've been pre-qualified because there's a difference between being pre-qualified and being pre-approved. Okay, pre-qualified is something that I do for everyone, which is kind of like a pre-approval, except we're not locking in the rate, which is the difference. Okay, so locking in a rate, we can do so for 120 days. That's no problem. But we only do that with one institution, to your point earlier. I won't do it with all of them, right? But depending on where we go, depending on when you buy, and depending on what the interest rates are at the time, we'll go back to that same institution that gave us the pre-approval. But a pre-approval requires all of your documents up front, right? So your job letter, your pay stub, your 90-day history of your down payment, pulling of your credit report. That all happens when you're getting pre-approved, okay? And we're actually locking in the rate. What I do is we pre-qualify you first, so that way you can start shopping around. And then as you start learning and start being educated on how it contributes to you specifically, then we start locking in rates and saying, okay, you know what? You're close to buying a home. Let's lock in a rate for the next 120 days, right? In the event if the rates change, we'll always get you the lowest discounted rate prior to closing. If they go up, you're protected, right? Because we've locked it in. So getting a pre-approval or getting pre-qualified is the first step that I would tell everyone to take, whether you're buying your first home or whether you're buying an investment property, or if you just want to get an idea. Like, you may not buy this year, but if you know that in the next 2 years, your income is going to grow, like the gentleman in the back who's just started his media company here, he's going to be, in 2 years, he can build his income and work towards earning X amount of dollars to qualify for that $800,000 property. But by him sitting down with Naveen and someone like myself, he knows what to do within those 2 years, right? How does this specifically apply to him? Okay? So in the event that you want to figure out what it is that you can qualify for and you want a real estate action plan, I'm going to pass you on to Naveen. He'll take down all of your information, and then he'll steer you into setting you up with my calendar and setting up an appointment with me to see if and how I can help. Okay?
And I also want to, first of all, thank you guys for coming in. And also want to let you guys, basically I've started a podcast in which I have already interviewed a home inspector. You can, like, if you need more information about the whole process, we have videos on YouTube. It's gonna be uploaded this week, like the coming week. So I've already introduced a contractor, home inspector, and what all things that needs to, like, you guys need to know as a first-time home buyer or an investor. And we're gonna continue it, and even this session gonna go over the YouTube. So if you want to, you can always you will get an email from us that will give you the link of this session and other videos, so that whenever you have time or you're interested, you can always go through that. That gives you more insight. And also we have books that's real estate intelligence, like that, which states the basic of real estate. Our team has put that book in, and you can always grab one. And thanks a lot, everyone, for coming. Thank you, Chris.
You're most welcome, Naveen. You're most welcome. You guys. And thank you. Thanks. Yeah. If you have any questions, we're here for a little while at the end, so you're more than welcome to.